If your tax strategy stops at funding your 401k or IRA, so basically qualified retirement account, you're doing the IRS a big favor, right? Because once you're investing in a tax-deferred account, basically the IRS becomes your silent investing partner. And if you don't play this right, they take a bigger cut than necessary. So in this video, I'm going to walk you through 5 taxable account rules I use with my clients to help them keep more of what they earn, invest smarter, and avoid unnecessary tax mistakes later down the road. See, this isn't about taking shortcuts. It's about intentional structure and smart decision making. So let's get into it. So rule number 1 is knowing what belongs in a taxable account and what doesn't, right? The first rule is simple, but it's constantly ignored. And not every investment belongs in a taxable account, right? Taxable accounts are best for tax efficient investments, not income heavy ones. So examples of what generally works well in a taxable account would be an index fund, ETFs with low turnover, those would be exchange traded funds, growth-oriented stocks like what you see in the Magnificent Seven, municipal bonds in the right situation. And examples of what usually doesn't work would be actively traded mutual funds, any assets with high turnover strategies, real estate investment trust, high yield bonds, and short-term trading strategies, right? So now you might be asking, why are stocks and ETFs usually the gold standard for taxable accounts? Well, it's because taxable accounts are a minefield of capital gains, dividend taxes, and basically a silent killer or tax drag. Unlike other investments like stocks and ETFs, they give you the steering wheel, right? They let you control and choose when you pay the IRS. And they allow you to qualify for lower tax rates and keep your money where it's supposed to be, compounding and in your pocket. So with that being said, a quick rule of thumb would be to put tax efficient investments in a tax advantaged account first. Your taxable account should be boring, it should be efficient and intentional. Now, rule number 2 is understanding capital gains before you sell. See, most investors don't realize they created a tax bill until after they sold. That's backwards. See, in a taxable account, every sale matters. And here's a key distinction. In short-term capital gains are held less than 1 year are taxed at ordinary income tax rates. And long-term capital gains are held for more than 1 year and are generally taxed at lower tax rates. This means timing is crucial. In selling an investment 1 week too early can literally double your tax bill. Before selling, you'll want to ask yourself these 3 key questions. In how long have I owned this asset? What tax bracket am I going to be in this year? And am I able to delay or even stagger this sale? See, the goal here isn't to avoid selling, it's to control when and how you sell. And rule number 3 is knowing how to use tax loss harvesting the right way. Now, tax loss harvesting is one of the most misunderstood strategies out there. At its core, it's simple, right? You sell an investment at a loss to offset gains or income. And the biggest mistake people make is thinking a loss is bad. A realized loss can actually be strategic, and here's how it works. See, capital losses offset capital gains dollar for dollar. If a loss exceeds gains, you can actually deduct up to $3,000 a year against ordinary income. And any unused losses can actually be carried forward indefinitely. But here's the catch. You have to avoid the watch sale rule. That means you can't sell an investment at a loss and buy the same or substantially identical investment within 30 days. The smart move here would be to sell the losing position and replace it with a similar but not identical investment. Now you can stay invested while capturing the tax benefit. This is where taxable accounts become powerful when managed properly. Now, it's very important that you pay attention to this next part, because this is a common misconception in that dividends are not free money. Dividends feel good because they hit your account and it feels like a payday, right? But in a taxable account, dividends are taxable whether you reinvest them or not. Now there are two types, right? There are qualified dividends taxed at long-term capital gains rates, and there are non-qualified dividends taxed at ordinary income rates. Many investors unknowingly build dividend-heavy portfolios in taxable accounts and create a higher annual tax bill. They have less control over timing. They reduce compounding interest. This doesn't mean that dividends are bad, right? What it means is that allocation is crucial. And high income strategies often belong in IRAs, Roth accounts, tax deferred vehicles, and taxable accounts are all about control, not forced income. Now, if you value flexibility, this is where your taxable account shines. Now, here is the biggest mindset shift. A taxable account is not a backup 401k. It's a planning tool, and a taxable account gives you liquidity without penalties, gives you flexibility before age 59 and a half. It gives you control over when taxes are triggered, and then opportunities for strategic gifting, charitable giving, and legacy planning come into play as well. See, taxable brokerage accounts are also great for early retirement bridges. They're great for business owners. They're great for stock compensation planning. They're great for Roth conversion tax management. And when coordinated correctly, taxable accounts work well with your retirement accounts, not against them. The mistake is treating all accounts the same. The big one here is understanding each account and its job. The tax-efficient investing isn't about complexity. It's about knowing where investments belong and understanding how taxes show up. See, making decisions with intention instead of reaction is important. If you're building wealth and ignoring taxes in your taxable account, you're actually giving away returns you worked hard to earn. If you found this video helpful, like the video, subscribe for smarter money strategies, and share this with someone who thinks investing ends with their qualified retirement account or their 401k.